Raise your hand if this sounds familiar. The Fed cuts rates, the headlines celebrate. You check your mortgage rate, still 7%. You check your credit card, still 24%. You check your savings account, which is technically paying you more than it was 2 years ago, except everything you buy costs 30% more, so it doesn't actually matter. You're doing everything right. You have a job, you're saving, you read the news. God help you, you read the news. And every single day, someone in a suit tells you the economy is resilient. Things are improving. The soft landing is happening. And yet, your rent is still insane. Your 401k does something terrifying every few months for no reason anyone can clearly explain. Here's the thing. The reason it's happening isn't in Washington. It's not the Fed. It's not Wall Street. It's Japan. Yes, Japan. And I know that sounds like the least threatening sentence in the English language, but stay with me, because what's happening there right now is the most important financial story getting almost zero mainstream coverage. It's slow, it's technical, it doesn't have a villain you can put on a thumbnail, but it is quietly, methodically making its way to your wallet, and you were never told it existed.
Let me tell you about the greatest deal in American financial history. America didn't negotiate it. America didn't sign anything. America didn't even know the deal existed. America was just going about its business, buying houses, running deficits, consuming at an absolutely heroic pace, while one of the largest pools of investment capital on Earth quietly showed up every quarter and kept the whole thing affordable. Here's the deal. For 30 years, Japan's financial institutions, banks, pension funds, insurance companies, were locked in a domestic market that paid them literally nothing. Their own government bonds yielded zero, sometimes less than zero, which, by the way, is a sentence that should never exist in a functioning economy. But here we are. So all of that capital, trillions and trillions of yen, had to go somewhere. It went to America. It bought U.S. Treasury bonds. It bought American mortgage-backed securities. It bought corporate debt. It showed up, quietly and consistently, and absorbed massive amounts of American borrowing at suppressed yields. Translation: Japanese financial pain, 30 years of stagnation, deflation, and economic misery, was the hidden engine keeping your mortgage cheap, your corporate borrowing affordable, and the entire American cheap money era running smoothly. You didn't know you were getting a subsidy. You were absolutely getting a subsidy. And now Japan is healing, which is great for Japan and genuinely terrible for you. Because when the subsidy ends, someone has to pay. And that someone, statistically speaking, is anyone trying to buy a house, service a loan, or retire comfortably in America. Fun times. Let's understand how we got here. The late 1980s. Japan is on fire, economically speaking. Their stock market tripled. Real estate went completely vertical. Banks were lending aggressively. Companies were expanding globally. And Japan looked like it was about to become the dominant economic superpower of the 21st century. Then, as is tradition with all great bubbles, it popped. At the peak, the land under the Imperial Palace in Tokyo was theoretically worth more than all of California. I want you to sit with that. A single piece of land, in one city, worth more than an entire American state. That's not an economy. That's a collective hallucination with a currency attached. When it collapsed, Japan entered deflation, which sounds like the boring cousin of inflation, until you understand what it actually does. Inflation means prices rise, so you spend now because things cost more later. Annoying, but functional. Deflation means prices fall, so you wait. Why buy a car today if it's cheaper next month? Why invest in equipment if everything is getting cheaper? The rational move for every individual actor in the economy is to hold cash and wait. And when everyone does the rational thing simultaneously, the economy seizes. Companies don't invest. Consumers don't spend. Businesses can't sell. Nobody gets paid. The spiral feeds itself. Japan lived in this loop for 15 years. To fight it, the government borrowed, massively, continuously, for decades. Japan's debt-to-GDP ratio climbed to somewhere between 220 and 260%. Let me translate that into something human. If you earn $100,000 a year, a 100% debt-to-GDP means you owe $100,000. The United States, at 125%, means you owe $125,000.
Economists get nervous around 90%. Japan, at 250%, means you owe $250,000 every year on a $100,000 salary. The only reason this didn't immediately explode is that the Bank of Japan nailed interest rates to the floor. 0%, sometimes negative. They launched quantitative easing. They introduced yield curve control, which is the central bank essentially saying we will buy as many bonds as it takes to keep yields capped. Market be damned. The Bank of Japan now owns over 50% of all Japanese government bonds. On the 10-year specifically, 90%. That is not a bond market. That is a central bank cosplaying as a bond market, while the actual market watches from outside, wondering if anyone will notice. This system worked, barely, as long as Japan had no inflation. Then inflation showed up. And here's where it gets darkly funny. After 30 years of desperately trying to create inflation, spending trillions, printing aggressively, holding rates negative, Japan finally got it, right when the rest of the world was raising rates to kill theirs. You genuinely cannot make this up.
By 2023, Japanese consumers were noticing something unfamiliar. Prices were going up. The rice ball that used to cost 120 yen now costs 140. Utility bills climbing, import costs rising. For an American, 10% more expensive is annoying. For a Japanese consumer who watched prices stay flat for 3 decades, it's genuinely disorienting. Like discovering gravity works differently than you remembered. And now the Bank of Japan faces a trap with no clean exit. Option A, raise rates to fight inflation. Sounds sensible. Except Japan already spends 25% of its entire national budget servicing existing debt at near zero rates. Raise rates meaningfully, and that number compounds fast. Fiscal crisis. Option B, keep rates near zero. Inflation continues, the yen weakens. Everything Japan imports gets more expensive. Every Japanese person gets poorer in real purchasing power every single month. Slow motion currency crisis. Option C, print more money to paper over everything. Works right until it doesn't. And when it stops working on $8 trillion in debt, the word hyperinflation stops being hypothetical. There is no good option here. There is only a menu of different kinds of pain. In 2024, the Bank of Japan chose to start raising rates, carefully, slowly, for the first time in 17 years. Here's the part I need you to understand. This is the whole video in one sentence. That decision, made in Tokyo by people managing a crisis you've never heard of, about a debt problem that predates your career, is why your mortgage rate won't come down even when the Fed cuts. Let that land. Let me walk you through the chain, step by step, because this is where most explanations get vague, and vague doesn't help you. For 30 years, Japanese institutional investors ran what's called the yen carry trade. Step 1. Borrow yen at near zero interest rates. Step 2. Convert yen to US dollars. Step 3. Buy US Treasury bonds yielding 4 or 5%. Step 4. Collect the spread. Borrow $1 billion worth of yen at 0.1%. Earn 4.5% on US Treasuries. That's $44 million a year in profit. For moving money between two countries and filling out some paperwork, it's the most boring arbitrage in history. And it ran for 3 decades at a scale that reached, depending on who's estimating, somewhere between $4 and $10 trillion. To put that in perspective, that's larger than the entire German economy. Trillion, with a T. Now, Japanese 10-year bond yields have moved from near zero to over 2%. The 30-year recently touched near 4%. If you can earn 3.3% in Japan in your own currency with zero conversion risk and zero hedging costs, why take on all that complexity to earn 4.5% in America? Increasingly, you wouldn't. So Japanese institutions are selling US assets, converting dollars back to yen, bringing the money home, quietly, methodically. This is called repatriation, and it is one of the most significant capital flow shifts in global finance right now. Here is the direct line to your wallet. The Federal Reserve controls the overnight lending rate, one rate, for one-day borrowing between banks. That is the actual scope of their power on interest rates. Your mortgage is based on the 10-year Treasury yield, which the Fed does not set. The 10-year yield is set by supply and demand. Specifically, how many buyers show up to purchase U.S. government debt, and what yield do they require? Japan held $1.2 trillion in U.S. Treasuries. When that buyer steps back, demand falls. Yields rise to attract new buyers. Mortgage rates follow. On a $400,000 home,
1 percentage point on your mortgage rate is $250 more per month. Over 30 years, that's over $90,000 in extra interest out of your pocket because of a portfolio decision made in Tokyo by someone you've never heard of, managing a problem you were never told existed. The Fed can cut all it wants. If the long end of the curve doesn't cooperate, your mortgage doesn't move. This is not a glitch. This is the system working exactly as designed, just with different inputs than you were told to expect.
Here's the part nobody wants to say out loud. The US government runs over $1 trillion in deficit spending every year. Every year, the Treasury has to sell over $1 trillion in new bonds, on top of rolling over existing debt that's constantly maturing. Someone has to buy all of that. For decades, Japan was the anchor of that buyer base. Not because Japan loved America, because Japan had no better options. That dynamic has changed. Japan now has options. When Japan has options, America has to compete for capital, which means offering higher yields, which means American borrowing gets more expensive, which means the deficit costs more to finance, which means even less fiscal room for anything else. And nobody is stepping up to replace Japan. China has been quietly reducing US Treasury holdings for years. Not dramatically, just steadily. The way you'd ghost someone when you don't want a confrontation. Middle East sovereign wealth funds are diversifying. Central banks globally are buying more gold and fewer dollars at a pace not seen since the 1960s. In other words, every government on Earth is trying to borrow money at the same time. The US needs buyers. Europe needs buyers. Japan needs buyers. The UK needs buyers. And there are only so many large institutional investors in the world. They are all being pitched simultaneously by every major government on Earth. America built a $36 trillion debt structure on the assumption that someone would always show up to buy it at acceptable rates. Japan was a cornerstone of that assumption. That cornerstone is moving.
Where does this go? Because doom without a framework is just anxiety with better vocabulary. Let's actually think through the outcomes. Scenario 1, the slow grind. Japan raises rates gradually. Repatriation happens over years, not months. Markets absorb the shift slowly. US Treasury yields stay elevated, but don't spike catastrophically. Mortgage rates stay above 6% for years. The stock market trades at lower multiples. Corporate borrowing stays expensive. Growth slows. Nobody declares a crisis, no crash, no villain, no emergency press conference, just a decade of financial conditions being tighter than they used to be. Quietly, persistently. While every politician takes credit for things improving, and none of them mention why it still feels hard. This is the most likely scenario. And I say this with full awareness of how grim it sounds. It's the one where you get poorer in slow motion, and nobody ever explains why. Scenario 2, the fast unwind. Something external shocks the system. A geopolitical event, a sudden, sharp move in the yen. Japan raises rates faster than expected. Japanese institutions don't gradually reduce US holdings, they sell at pace. We've already seen the preview. In early 2025, Japanese investors dumped over $20 billion in foreign bonds in a matter of weeks. Markets buckled, stocks dropped, bond yields spiked. Everyone looked confused on financial television. That was a tremor. A full disorderly unwind would be the earthquake. Treasury yields spike. Mortgage rates follow violently. Corporate borrowing locks up. The Fed gets caught between cutting to support markets and holding to manage inflation. Pick the wrong one. Different kind of catastrophe. Scenario 3. Full fiscal crisis. The tail risk. Japan's debt becomes unmanageable at higher rates. The Bank of Japan prints at scale. Confidence collapses. Every asset Japanese institutions hold globally gets liquidated, simultaneously. This ripples through global credit markets in ways that are genuinely difficult to model. Likely? No. Impossible? Also no. 15 years ago, the idea of a developed nation running negative interest rates for a decade was also considered impossible. The question isn't whether this affects you, it's whether it happens slowly enough that you can plan for it. The financial shifts that actually change your life are never the loud ones. Never. The loud ones, the ones trending, the ones getting breathless coverage, those are already priced in. Markets front-run the obvious. By the time it's on the front page, the money has already moved. The dangerous ones are the slow, structural, boring rerouting of capital that happens while everyone's watching the press conference. The ones that don't have a villain. The ones that require patience to understand and more than a headline to explain. Japan is that shift. And it matters not because of what's happening in Tokyo. It matters because of what it means for you. The person trying to buy a home. The person watching their 401k do something inexplicable. The person who did everything right and still feels like the math isn't adding up. You weren't imagining it. The system was running on a hidden subsidy. The subsidy is ending. The bill is arriving. And the people who were never told they were getting a discount are the ones who will feel it most. That's why this channel exists. This is Breaking Money, and we'll see you in the next one.